All right, welcome back to another episode of Asset Coach and Tax Strategist. My name is Robert Wolf, and I'm an asset coach and tax strategist. And this channel is really designed for us to understand and read between the lines of various rules, regulations, laws, effects that are passed and that are out there to affect really what we call economic termites. Economic termites are taxes, inflation, time, and then laws and regulations being our politicians. And so not always is it bad things, but it's good things. It's just any type of news. And so today's episode is about I think the kind of some of the earth-shattering conversation that we keep hearing from Trump in different areas. And this kind of came out of nowhere. It makes sense, but I wasn't expecting this, but here it is. And so I find it to be very interesting. I'm excited to be able to share this with you guys. I do have some concerns with it as well that I'll share as we go through this, but let me go ahead and share my screen and let's talk about this first. The first things first, this is from the White House. Democratizing, easy for you is to say, access to alternative assets for 401k investors. This was August 7th of 2025. This is an executive order, and this is from Trump. And so what is this? Well, we can go through this. I'm gonna go ahead and highlight this, and it's gonna be part of the episode, the note. But I wanted to go to something else, a bipartisanpolicy.org, and utilize their research and use their explainer rather than the letter that is coming from Trump. So you're welcome to read this. Again, it's going to be in the note section, but this will be also in the note section. Defined contribution plans such as 401ks are allowed to offer investments in so-called alternative assets classes outside of stocks, bonds, and cash, and allocations to alternative assets such as real estate and some commodities regularly appear in defined contribution plan menus. Now, let me make this clear, first of all, because we're going to be talking about investments, we're going to talk about 401k plans. I am not giving investment advice. I'm not recommending any investments. This is for educational purposes only. This is really just designed to give you some information. You need to seek your own professional help and guidance on if you decide you want to do something. This article, by the way, was done in July 25th, 2025. So recently, however, interest in alternative assets and especially in private equity and private credit has grown. High profile developments in both federal policy and financial markets have helped elevate the conversation around expanding alternative investment choices in 401k type plans. Major retirement plan provider, including Vanguard, State Street, have announced that they have begun offering private equity and 401k plans. And federal court recently ruled in favor of Intel after its inclusion of private funds in its 401k plan with was challenged over concern over high fees and risks. Policymakers, now this is a good point. So the interesting thing is that in current retirement planning, mutual funds, 401k plans, there was this huge drive of fees, and focusing on fees and reducing fees and all this fun stuff. And I'm not saying that that's a bad thing, but that was a big focus. And the reason why that was such a big focus is that the reality is that there's a lot of mutual funds. There's a lot of investment companies seeking your dollars, and the reality is there's only so many stocks, bonds out there. There's a finite amount. And the mutual fund companies, when you look at the major mutual fund companies, you look at the top holdings of a lot of these mutual fund companies, they're going to be the same companies you see all the time. It's going to be the Magnificent Seven for sure. And they're going to, depending on if it's growth in income, alternatives or REITs, if it's going to be international, tech focus. So really, if you focus on the type of mutual fund, most of the times, if you go to the tech fund, it's going to be in the same top holdings. If you go to a real estate fund, it's going to be all the same top holdings. If you go into an international fund, it's going to be all the same top holdings. It's really, they all kind of the same flies to the same lights. And the reason why I bring this up is that fees were such a big driving force to really commoditize the 401k and investment marketplace. But private equity, they're higher. The fees are higher because they're doing more work. There's more going on, which therefore equates to more risk. Okay. So we went to this focus on risk and fees since 2008 to now. And now we're looking at adding these other investments. Why? And the reality because is the returns have been mediocre. They really have been. They've been mediocre. Most mutual fund companies do not outperform the S&P 500. Okay. Now, policymakers now with the S&P 500 is really driven off as the top 7 companies. Okay. Really the top 10, but we'll say the top 7 because it's called the Magnificent Seven. So that means 493 other companies of the S&P 500 aren't really adding to it. If you look at various studies and reports and financials, they're really generating about a 5% return of the remaining 493. But the top 7 are generating closer to a 26% return, right? That's a significant difference. So people wanting to go through, I would much rather people in their 401k plans have self-directed options than having access to private equity. That would be my opinion. In alternative assets, I would rather that people have the ability to go choose their own stocks, their own bonds in their 401k investments, rather than saying, "Hey, here's alternative assets," and actually increasing risk and higher fees within those funds. Because people, the end of the day, people still don't know what they're doing. That's the reality. That's why target funds became so popular. People would just put their money in the target funds and just leave their money go. A target fund is basically based on your age. It already has a balancing of investments, and each year you get older, it gets more and more conservative, and you choose the age that you're supposed to retire at, and that's the age that it starts to effectively change. Okay, that's just a quick high level. There's more into it, but you get the idea. Policymakers have also shown interest. The Securities Exchange Commission recently noted that private markets have become a more important avenue for investors seeking greater access to investment opportunities and an expanded menu of investment products for portfolio diversification. A White House executive order addresses the topic is expected any day. Now, here's the other thing. Alternative assets are basically a function of being an accredited investor. Most alternative assets are designed for accredited investors. Now, some alternative assets do allow non-accredited investors, but they're highly regulated. The fees are much higher due to the risk and the higher regulations. So, if the common non-accredited investor does have access to alternative assets, then what's going to happen is that yes, the fees are going to be higher, and there's going to be a huge influx of dollars into these different types of assets. And so you may or may not be actually causing more risk because of the types of alternative assets. Are we going to use alternative assets only offered by Vanguard, State Street, Fidelity, Schwab? I don't know. It depends because most alternative assets focus on accredited investors due to the ability and the sophistication of an accredited investor. So these are all things that I'm certain have to come out here. Even after the Department of Labor clarified in 2020 that private equity can be offered in multiple asset classes vehicles such as target date funds. So I was just talking about target date funds. So having a private equity in target date funds actually may not be a bad thing because target date funds are a already diversified, structured investment for people that just want to put money in there and not think about it. Most plan sponsors remain hesitant to offer options that invest in private markets. This hesitance will likely persist in the absence of additional guidance from federal agencies or Congress articulating the conditions under which alternative assets can be offered in DC plans. And really, it's kind of what I'm just talking about regarding accredited investors and non-accredited investors and what type of assets. Are we going to just talk about real estate assets? Are we going to talk about private equity and business? There's a lot of functions in this that really need to have more guidance, especially if you're going to be offering it into. I'm not a big one of regulations. I I do feel like there should be a balance, but when we're talking about something like this in retirement accounts where most people have this is most of their wealth, and most people are in 401k plans, but they don't have any invested interest, so to speak, in learning about their 401k. That's why target date funds are so popular. People just put their money in there and don't even think about it. Most people don't look at what their investments are doing. If so, they would argue there would be way more conversations, way more articles, way more noise about what's going on in the investments and the performance in 401k plans right now. But that's not the case. So, what are alternative assets? We're not going to go through all of this, but basically, they're private equity ownership stakes in companies that are not publicly traded. They're private credit loans provided to companies outside of public markets, and in cryptocurrency, which are digital assets such as Bitcoin. Okay, so these are going to be the three main ones. Really, kind of the driving force is probably going to be the cryptocurrencies. But in my opinion, I think one of the better ones would be the private credit, the loans. But there's such risk in all three of these areas for the common investor, which is really why I'm concerned about this being available to the general public. If you're a non-accredited investor, there really needs to be a lot of safeguards within this opportunity. Do I think I think the public should have this? Yes. Do I think the public's ready for this? No. Because there's not a guideline. There's going to be a lot of greed, right? Shocking, right? I said a lot of greed. There's going to be a lot of greed. There's going to be a lot of dystopia. There's going to be a lot of blindness to the realities of what's going to happen in market trends. If there's economic downturns, these are areas that could actually hedge economic downturns, but also could encourage or cause greater risk depending on where people put their money. And that's the thing. They don't know where they're going to put their money. When you look at public and corporate pensions, they have about 23% of their portfolios are in private markets. But these pension funds have billions and billions of dollars, and they're set up as separate investment funds already. They have to. So they also have stocks, bonds. They're not just traditional retirement plans where they're just going to look at a bunch of mutual funds. Okay. They have billions of dollars allocated that they are basically their own private equity fund. And that's the reality is one of the terms is called a fund of funds. Or you have a private equity fund that's designed to go invest in other funds, creates diversification, more allocation, and risk mitigation. But you can read the rest of this. Potential risk of private market investments and retirement plans. Private markets offer significant potential benefits, but concerns remain about the stability of alternative investments and everyday the inflow and the liquidity into the alternative and private markets, when you release this away from the current pension funds or the current mutual funds and 401k plans, and you start releasing those funds into it's just, I think it's going to cause a lot of issues. And you do have like liquidity constraints compared to stocks and mutual funds. Private equity and private credit investments are relatively illiquid. There's liquidity events, meaning there's hold periods because your money's actually in a real physical big asset. Stocks, bonds, mutual funds are liquidity assets. That's the risk that you're managing with allocation diversification. With alternative assets, your money is actually in the asset, so they're less liquid. You can't just, if something's going the wrong way, you can't just release and sell your funds. And so that's a big issue. So, anyways, you can see this in the notes. You're welcome to read this on your own, as well as the letter from Trump on this. Do I think this is a good idea? I do. Do I think that we're ready for it? No. There definitely needs to be some guidelines and maybe even a certain type of alternative asset fund within the 401k plan. So it'd be just no different than the menu of funds that a participant has, and they can decide to put some money in here, but limited to the amount that they could put in there. Until this whole thing gets tested and data gets proven and stuff, there needs to be really certain some safeguards. That's what the whole ERISA laws are there, just to protect the private investors, the retirement account investors. So that's my opinion. Hey, if you like this content, give us a thumbs up. Add your comments down below. If you haven't subscribed yet, go ahead and hit the subscribe button. We drop episodes every Thursday. Once again, thanks for being here. Make it a great day.